All right, we're going to take a quick look at 2021 and just reflect on what happened during the year and point out some key things that happened during the year that really shaped the outcomes for the year. So let's first look at the bongo board for 2021, Mike, and take us through the returns. Let's focusing on the year to date, obviously.
Yeah, and we'll give a quick update on December and then work ourselves to the right to that year-to-date column. So just capping off the year, month to date, the month of December, S&P up almost 4.5%. All major equity indices, foreign developed markets, U.S. small caps, emerging markets, all positive returns during December. And this is obviously despite a lot of negative stuff going on in terms of, for example, the Omicron variant just ripping through the globe and setting new records in COVID case counts in many areas. The rest of the alternative space, fixed income space, interest rates moved up just a little bit, so you saw some negative returns for the Barclays U.S. Aggregate Bond Index, but areas of the credit market, high yield bonds, strong month, emerging market bonds, strong month, global REITs up, significantly, and then commodities once again gaining. So a great month to end what was a great year. So we go over two columns. You get the year to date and the 1 year. Those are the same numbers because these numbers are all as of the end of December. And really just a fantastic year for U.S. equities in particular, and the S&P 500, getting even more specific. So the 500 largest stocks up over 28% for the full year. And the largest peak to trough drawdown during the year was less than 5% down. So pretty much just straight up and to the right. A little bit of volatility in September, a lot of changing market dynamics throughout the year. The types of equities that did well throughout the year changed quite a bit. But at the overall index level, just another fantastic year. 3 straight years of double-digit returns for the S&P 500.
So that's basically saying on the S&P, almost 75% return on a cumulative basis over the last 3 years.
Yes.
Yes.
75% over the past 3 years. I mean, 16.5% annualized over the past 10 years.
Yeah, I mean,
I don't think there was any forecaster 10 years ago who said their expected return for the S&P 500 over the next 10 years is 16.5% annualized. You would have been laughed out of the room.
yeah. So COVID, that's COVID. That's a good vaccine for COVID, actually. Okay, so let's talk a little bit about the S&P in particular. We have an interesting chart that sort of is one of the foundational beliefs for our investment philosophy, is that really flows matter and assets matter. And this is a great representation of that philosophy here. So tell us what we're looking at.
Yeah, this is the S&P 500 index in green. This is since the beginning of 2007 through the end of this year, versus Fed assets in the blue shaded. So right now, Fed assets are about 8.5 trillion. And you can see these lines, they don't lay right on top of each other, but there certainly is correlation. There's a lot of debate as to whether or not there's causation. One of our favorite quotes was from Ben Bernanke, who was, brought quantitative easing and rapid increases in Fed assets, brought that to the table and actually implemented it during the global financial crisis. He said, quantitative easing doesn't work in theory, but it works in practice. And this chart clearly shows that is exactly right. Like the mechanics of the Fed actually adding assets to their balance sheet. All they're doing is going to a bank, a large primary dealer bank, saying, I will swap you one risk-free asset, bank reserves, for another risk-free asset that you have, treasuries, agency mortgage-backed securities. That's all it is. In theory, that's nothing, right? It's just a risk-free asset swap from the central bank to a primary dealer bank. But in practice, you can see what happens. When the Fed is buying assets and assets are increasing, it's juicing stock returns through the wealth effect. We've talked a lot about this in prior CAP STRAT Uncapped videos. Wealth is the new growth. It's manufacturing higher earnings per share. It's keeping interest rates low. It's keeping corporate bond yields low. It's facilitating things like buybacks, return of capital to shareholders. As companies buy back shares, they reduce the amount of shares outstanding, which increase earnings per share. You assign the exact same PE multiple to higher earnings per share. What you get is higher stock prices. So these things the S&P has finally caught up to Fed assets in 2021.
It's interesting though; it hasn't surpassed like in prior cycles. So, does this simplicity of this is beautiful, the elegance of it. So, does this state that if the Fed takes their foot off the gas, we're in for a correction here?
So obviously, if this were a one-to-one relationship with no lag, then you would say that this year the S&P 500 should go nowhere, because once we get to March, Fed assets should level off at somewhere around 8.7 trillion. They should just start moving sideways. But what you see is the last time the Fed leveled off assets on their balance sheet. So in 2014, they finished their taper and they started leveling off assets. You really didn't get anything nasty in the equity market until they went one step further and started quantitative tightening, the opposite of quantitative easing, actually reducing the size of their balance sheet.
And you can see in that graph from 2019 to now, we've gone from around 4 trillion to 9 trillion. And that's 75% return cumulatively in the S&P.
Yep, matches up pretty well. You can see the bottom on the S&P 500 during COVID pretty much matched up with Fed assets just perfectly. The Fed called the bottom. There's your support level. So this has definitely been extremely supportive. And there's no doubt that even if the Fed is to level off asset purchases and Fed assets go sideways, in our view right now, as long as they continue to react to what the market says to them, which we think they will, the market is very important, then it's unlikely that we'll ever get back down to 4, 5, 6 trillion in Fed assets. I mean, this chart is higher highs and higher lows. So when the next crisis comes around, what are they going to do? Well, they're going to buy assets, probably more assets, different types of assets. They did some things during COVID they'd never done before. Who's to say next time there's a crisis that they wouldn't go even further into doing things like buying equities, ETFs, things that the Bank of Japan is already doing and has been doing for quite some time. So overall, very, very supportive, as long as Fed assets stay at this level, and as long as if there is an economic downturn or a market downturn, the Fed has the same reaction function. That is all very supportive.
Let's move on to COVID cases, because we're like right in the throes of the Omicron surge right now, and there's a lot of concern about how the reaction function should change. And it seems to be there's some ideas that the reaction function is changing in some parts of the country, and the other element of it is we think this wave is going to run through fast. So let's throw up the graph on the COVID cases and look at the unbelievable acceleration as expected here in the first part of the year.
Yeah, it's tough to see because it's literally straight up. The light blue line is case counts, moving straight up. We had a day where we reported 1 million new cases. That's a new record. Totally blowing the Delta wave and the wave from last winter almost off the scale. So double the prior high in the US in terms of case counts. And so this is make or break time for policymakers, in our view, because all of the data, all of the news, all of the reports thus far have supported this idea that Omicron is obviously far more transmissible than even Delta, but less deadly. And we know that hospitalizations and deaths follow cases at about a 2-week lag. So this should be the time where all policymakers who maybe have held off on more stringent lockdowns are saying, hey, I'm going to find out here really quick if this rapid surge in cases is actually going to result in the hospital system being overwhelmed. And if that's not the case, then we think that will support a less stringent reaction function in many places. It varies so much now, state and locally. We feel pretty confident the federal government is not going to bring forth strict lockdown guidance. They seem to be more on the side of pushing vaccinations and boosters as their primary reaction function.
Mhm.
But state and local governments, especially as kids are supposed to be coming back to school here, they're at make or break time to see if they can follow less stringent reaction function and if that's going to play out and the healthcare system doesn't get overwhelmed.
Yeah, and I just would maybe pose the question to you, because we discussed this quite a bit, but do case counts even matter anymore? Like what's the metric we should be thinking about as we sort of move towards this being an endemic?
Well, we've been of the opinion that once the at-risk population was sufficiently vaccinated or significantly vaccinated, and once vaccines and boosters are broadly available, and since we know that those generally keep people out of the hospital, that cases should not be the primary thing that policymakers are reacting to anymore. You should be reacting to hospitalizations. Because the whole idea of lockdowns and stringency is to avoid the healthcare system from being overwhelmed. That's why we went into lockdown originally, right?
Right.
And so that has been our view. There have been a number of jurisdictions, state and local governments, and policymakers that have just gone back to the old reaction function. Hey, I'm going to look at cases, and all of my levels of lockdown stringency still are tied to cases. I haven't updated those. Um, so, in our view, they should be reacting more to hospitalizations. Some, out of an abundance of caution or a failure to adapt, have continued to react to cases.
Yeah. And the market doesn't seem to care about case counts anymore because it's basically gone straight up with case counts. As the cases have gone up, the market's gone up.
Yeah, and we think Omicron is right in line with our theme for the 2022 outlook of this idea of COVID indemnification, END. This is what a virus looks like when it becomes more endemic. It's absolutely everywhere. It's very difficult to avoid transmission, virtually impossible. If you were to implement policies to avoid transmission, you would effectively have to shut down the entire economy, and nobody wants that.
Yeah.
Absolutely nobody wants it. So people are going to continue to do what they want to do because they feel like they've earned it. They've followed the science. They've done everything that's been asked, and they're not going to put off experiences any longer. And Omicron, it's totally possible that this rips through, and by the end of February, case counts are coming down 20, 30, 50%, the 7-day moving average every week if you look at what's happened in South Africa and other areas. So it could look very different come springtime.